The South African junior diamond mining sector has a lot of challenges which it needs to overcome if it's to flourish, especially a significant credibility gap with bankers and investors. This according to Paul Loudon, who's the CEO of Diamond Corp, who believes that the sector has done a lot of over-promising and lots of under-delivering. He joins us now in studio for more on this. Paul, thanks so much for joining us this morning. Well, it seems that you're pretty critical of the way business has been done in this sector, so far. So let's put the cards on the table right now in terms of your view on the state of the diamond mining sector in South Africa.
Well, Alicia, it's not just diamonds, it's probably across all commodities, where a lot of junior companies have come into the sector in the last 7 years or so, and they've taken projects that had been looked at previously by other operators and thought that, oh no, the reasons that they were rejected previously no longer exist, because this time the boom is different, that prices will keep on going, and it's not the case. Mining fundamentals really don't change. At the end of the day, you must have robust projects. So over the last 5 or 7 years, a lot of money has gone into projects that really looked marginal, and were hoping and praying that diamond prices would keep on going to make them look economic. Well, guess what? This boom's no different to any other boom. It's taken the breather and prices have come down.
Has the penny finally dropped?
Well, the reality is now setting in, because junior resource companies now, the capital markets are basically shut to them. We were lucky enough last year. We struggled for 18 months to get financing away for our project with extremely robust fundamentals, and it was a project that we'd been working on for 5 years. Lesser projects than that are going to struggle. So
companies with the right fundamentals fighting the perception now, and needing to put the reality on the table for financiers a little bit more aggressively.
No, that's right. I mean, you need to keep, you have to have your hurdle rates high on any mining project, and especially diamonds. Diamonds face pricing challenges that you don't see in other commodities, but the long-term fundamentals for the sector are very strong. But at the same time, we've got input prices coming up. So a project today, if you've got a strong project today, it's more than likely that it will be stronger. It will survive in the long term, because yes, diamond prices are going to go up. But if you've got a project today that looks marginal, then in all likelihood, any increase in prices going forward are going to be offset by increases in input costs.
Well, as long as women are on Earth, the diamond prices are going to go up. Let's take a look at that demand-supply dynamic right now, and how that's influencing prices, what your projections are for the outlook of this industry on that basis.
Well, the market fundamentals are very strong. The world can't produce enough rough diamonds going forward. Supply, your demand will outstrip supply significantly in the years ahead, and that's because diamonds really are quite rare in terms of the sources, and the major sources of diamonds in the world are reaching their peak and will start to decline in the years going forward. And natural diamond sources as we know them today will probably be exhausted within the next 25 years. So the price will go up. You're going to reach a point where where the consumer says, well, we'll start to look for alternatives.
Just taking a look at the input costs that you alluded to. Of course, this is a challenge across the industry. It's across industries at large. How are you dealing with the input cost pressures right now, and what kind of support is necessary to support the sector moving forward, especially from government side, where we've had government pretty emphatic about the kind of beneficiation that should happen? Should more incentive be put on the table, alleviating some of the cost pressure, but incentivizing junior miners to explore beneficiation a little bit more aggressively?
Well, interestingly, the diamond sector has been subjected to beneficiation requirements from the government for some time now. We have to offer 10% of all of our production to the state diamond trader first, before we can sell elsewhere. So the diamond sector has accepted beneficiation for quite some time. In terms of cost structure, the cost pressures, for us it's diesel price increases. So we get a weakening rand, which is great in terms of selling diamonds in US dollars, but we're going to see that flow through into diesel price increases. The other big one is big challenge that we face is Eskom increases going forward. Now we budgeted for a greater increase than it looks like is going to happen. But the pressure, the onus now comes back on the company to look at how we can reduce our energy consumption, how we can do the processing of diamonds in a more energy efficient way. And interestingly, there's some quite new technologies are coming onto the market there, which really could help us in that respect as well.
Let's leave it there. Paul, thanks so much for having joined us this morning. Of course, Paul Loudon joining us with some perspective on the junior mining industry, and he's the CEO of Diamond Corp.